Okay, we're going to expand upon what we learned in the last few videos, thinking about stocks and bonds. And we're going to go from an introductory level to an intermediate level. There's a lot to talk about, and I think some of the stuff we're going to cover in the next couple of videos are some of the most important stuff in this class. A lot of people really are concerned about predicting the stock market, and what you'll see is that picking stocks is kind of a foolish way to think about investing. And it turns out that investing is pretty simple, based on data, based on returns that you can see from from professional investors and such. Seems like the choices are pretty clear for personal investors like me and you. So we're going to start out today talking about indexes. Okay, a stock market index is basically just a collection of stocks that are pulled together to provide information about how the stock market as a whole is performing. In some cases, this has to do with the type of stock that we're talking about. In some cases, it has to do with the size of the companies. But there's various types of stock market indexes out there. And you've heard of these. I'm sure everyone out there has heard of the Dow, right? The Dow Jones Industrial Average. Well, we need to understand what these are, okay? So let's talk about the Dow, or the Dow, I'm not going to write it out, but Dow Jones Industrial Average. I'm sure you've heard about, the Dow is up 2% today and so forth. What they're referring to is the 30 largest publicly traded U.S. companies. Companies can choose to essentially be private, or they can be corporations that issue stock and are thus publicly traded. And so the Dow Jones Industrial Average is the 30 largest publicly traded U.S. companies. So now these companies will get bigger or smaller, and they will drop out or be added into the Dow Jones Industrial Average. Okay, so when people talk about the Dow, this is what they're referring to. Okay, another really big one that you're going to hear about is the S&P 500. S&P stands for Standard and Poor's. And this is the one that people who are in the personal finance space care the most about, and we'll explain why. Part of the reason is because there's more companies in it. There are 500. So this is the 500 largest publicly traded U.S. companies. All right. So the S&P 500, the Dow Jones Industrial Average, you might just think, well, the Dow is just bigger companies. S&P includes some smaller ones. There's also a big difference in terms of how they're calculated, and we'll get to that in just a second. The third one that I want to just briefly mention is the NASDAQ. I forget what this term stands for, but the NASDAQ is both a stock exchange and a stock index. What I mean by that is, you guys have probably heard of the New York Stock Exchange. Well, the New York Stock Exchange trades a certain group of stocks, all right? It's the biggest place to trade stocks. The NASDAQ is also in New York, is the second largest place to trade stocks. So the NASDAQ is a place where people trade stocks. And the NASDAQ index is just all of the companies in the NASDAQ stock exchange. All right, so I believe there's quite a few. I want to say around 2,000 companies, but this is all companies traded on the NASDAQ. And these companies are primarily IT and other tech-related companies. I'm not sure about the history of the NASDAQ, but when you think NASDAQ, think tech, all right? Companies, for example, like Facebook, Amazon, Netflix, Google, companies like this, the so-called FANG companies, FANG being Facebook, Apple, Amazon, Netflix, and Google. Those companies are all traded on the NASDAQ. So if you see that the NASDAQ has been going up over the last few days, think basically the U.S. technical sector is doing very well. When it comes to personal finance, this S&P 500 is definitely the one you're going to learn to care the most about. And in fact, you can essentially invest in the S&P 500. A lot of people do. I think close to half my portfolio is just invested in the S&P 500. We need to understand why the S&P 500 is so attractive in that regard. So we're going to have to do a little bit of math. There are two ways that an index can be set up. Indexes can be price weighted and they can be value weighted. So it can be price weighted or value weighted. Okay, this has to do with how are you going to basically solve for the value of the S&P 500 or the Dow Jones Industrial Average. The largest company right now, I believe, is Microsoft. Microsoft and Apple are the two largest companies. So if they're really big, do we want to count them as being more important than, say, a small company? That's kind of the choice you have to make. If we're trying to analyze how the U.S. stock market is doing, you could make the argument that like Microsoft and Apple should be counted way more than a small company like J.C. Penney, right? So when it comes to this choice, there's basically two ways to set this up. The index can be price weighted or value weighted. Price weighted means that the relative share of a given company in the index is based on the share price. So what that means is, if there is a company that has a share price of $60, it will have twice as much impact on the index compared to a company that has a share price of $30. Let me say that again. If you got two companies, one is worth $60 a share, the other one's worth $30 a share. The company that's worth $60 a share will be counted twice as much in the index. Okay? That's the logic of a price-weighted index. It's kind of a stupid logic when you think about it, because we learned before that stock share prices are really pretty arbitrary. If I was going to issue stock for my company, I could issue just a few shares and have a very high share price, or I could issue billions of shares and have a tiny share price. So this is really not a very good way to weight an index. But unfortunately, that's the way the Dow Jones Industrial Average is set up, just because that's the way it was set up. Many years ago, somebody decided to set up the Dow Jones Industrial Average. They set it up price weighted, and even the creator of the index later on said that wasn't such a good move. So the Dow Jones Industrial Average, you'll see, is not really a good way to think about how the stock market is doing. Instead, you probably want to find an index that is value weighted. Okay? Value weighted means the relative share of a given company in the index is based on the value or market cap of a company. Remember, market cap is the overall value of a company based on the number of shares that are outstanding and the price per share. Okay, so a company like Microsoft, at the moment I'm talking, Microsoft is worth about $1.5 trillion in market cap. So value-weighted indexes are going to say, look, Microsoft is huge, so let's count them as being really important in the index. If Microsoft is worth $1.5 trillion, it's going to be 10 times more important in the index than a firm that's worth $150 billion. Okay? It's kind of a sound logic, I think, in the sense that if a company is 10 times larger, it's 10 times more important to the U.S. economy. And you could make the argument that you might want to have 10 times more of your portfolio invested in a company that's so much larger. Okay? So value weighted is a more reasonable way to set up an index because it values bigger companies more. Sometimes this is called cap weighted, by the way. So if you see that term, it's the same idea. Let me try to use some math now to explain the logic of this. So let's imagine we're going to create our own index. And we're just going to put a few companies in it. Let's stick with some of those companies we mentioned before. Let's go with Microsoft, Boeing, and Pfizer. These three companies are all publicly traded companies in the U.S. Definitely heard of these first two. This third one is like medical goods and such. These are all really big companies too. In fact, these are all in the Dow Jones Industrial Average. So they're among the 30 largest companies publicly traded in the U.S. This is actual data based on their current situation. The share price for Microsoft is $190, Boeing $216, and Pfizer 36. And remember, the share price is pretty arbitrary, all right? Sometimes these companies will do stock splits, or they'll do stock doubles. Not something you really need to know about, but in this class. But basically, a stock split would mean that they're just going to divide the stock up, all right? Divide it up further to change the value of each share. It's really just to make the price kind of stay within a given range. But again, it's all really arbitrary. The more shares there are, the lower the share price will be. Instead, it's the market cap that we really care about when we're thinking about the size of a firm. And so in billions here, Microsoft is worth 1,500 billion, or another way to put that would be $1.5 trillion, right? Boeing, much smaller, worth about 120 billion. And Pfizer is worth about 200 billion. Okay? So let's just think about this, all right? Let's think about how this would be set up if we were going to set up just an index with three companies. If we were setting it up like the Dow Jones Industrial Average, the index would be based on a sum of these shares. So if we add these up here, we get $442, all right? That $442 would be essentially the Dow Jones Industrial Average if we just did it for these three companies. You know, the Dow Jones Industrial Average that's quoted, you can look it up, whatever it is, $25,000 or whatever. That $25,000 is just the price if you bought one share of each of the top 30 companies. That's all it is, okay? And you should hopefully see why this is sort of silly, all right? In this case, which of these companies is going to be most important? Boeing is going to be most important. Put it this way, if Boeing goes up 10% in value, the index is going to go up by a big amount just because Boeing is arbitrarily weighted the highest of these three companies. If Boeing goes up 10% and Pfizer goes down 10%, the overall index is going to go up by a lot because Pfizer is treated as a very small entity in the index. Pfizer is less than 10% of the overall index. That's the problem with price-weighted indexes. They arbitrarily value some companies more than others. So here's the thing. When I see that the Dow Jones Industrial Average has gone up 1%, I know that doesn't really tell me a whole lot because maybe it's just a company like Boeing that's done very well. And in reality, Boeing's not a very big company, so this isn't really telling me that much useful information. All right? Let's compare that now to how this would be handled if we used a value-weighted index, okay? A value-weighted index would be set up this way. We would add up the value of everything in the index, and then we would need to figure out how much each of these companies should fit into the overall index, okay? So basically, we would need to solve for the share of the market. All right, so what I would need to do, for example, for Microsoft, is I would take that 1,500 billion, divide it by 1820 to get an answer of about 82.4%. And then we would allow Microsoft to effectively make up 82.4% of the index. All right, that's how this would be set up. It's a bit more complicated than price weighted, but it does a better job of showing what the economy is doing overall, right? This is just three companies, but for the S&P 500, it's 500 companies. So if I see that the S&P 500 goes up 1%, that basically tells me that the economy is doing well, that at least the stock market, I should say, is doing well, because it represents 100 or 500 companies, and it takes the biggest companies and it counts them the most, which is reasonable because the biggest companies have the most employees, the most profits, the most revenues, etc. So it's going to value those that matter the most in the index, which is probably pretty reasonable. We would just do the same to figure out the other share in the index. we would see now that Boeing would be the least important in the index. And this would add up to 100%. And then we would just kind of arbitrarily decide how big a share is. We might say that, you know, the S&P 500, our S&P 3 that we set up here, would just be worth $100, okay? And if Microsoft goes up, it's going to be worth more. If Microsoft goes down, it's going to be worth less, and Microsoft's going to have the greatest bearing in this market, okay? So the S&P 500 and the NASDAQ are both value weighted, which is a better way to set up an index because it's more indicative of how firms are actually doing. It cares more about the firms that are bigger, which is a good way to set things up, okay? On a related note, while we're talking about the size of firms, some terminology that's going to be useful moving forward. You might hear people divide up firms into different sizes. You'll hear people talk about large cap, mid cap, and small caps, okay? Large cap companies are generally referred to companies with a market cap greater than $10 billion, all right? So large cap companies are the big companies. These big companies, there's about 430 or so of these, right? That number can change every day because, you know, companies getting bigger and smaller. But there's about 430 companies that make up the large cap group right now. So the S&P 500, which is the 500 biggest U.S. publicly traded U.S. companies, is primarily made up of companies that we would refer to generically as large cap. These are, you know, a lot of big companies that you've heard of, like the ones we've been talking about so far, you know, Microsoft, Amazon, Facebook, etc. The mid caps are sort of the mid-sized companies. Now, when I say mid-sized companies, these are still big, right? These are still really big companies because we're talking about the U.S. overall. But, you know, we're sort of just drawing a line and saying, look, there's some really big companies and then there's some companies that are smaller than that. This is the companies that have a market cap between $2 billion and $10 billion. And despite the fact that, you know, there's 430 at the top, there's about 500 companies here, and a lot of these you've heard of. So even though they're you know, mid caps, it doesn't mean they're, you know, just some sort of vague company that does stuff that you never heard of. A lot of these companies are companies you shop at. So just to give you a few, Under Armour's on here, Gap, TripAdvisor, just to give you a few. Obviously, I'm not expecting you to remember these or anything, but I just want you to basically recognize that, you know, these are companies you've heard of, and often in a lot of cases. So there's large caps, there's mid caps, and then there's a bunch of companies that are significantly smaller than that, and we call these the small caps. These are ones with a market cap less than $2 billion. And there's about 2,000 plus companies that fall into this small cap. In the U.S., there's obviously way more companies than the ones we're talking about here. We're just discussing the ones that, you know, are publicly traded, have issued stock. So, you know, a company like Blackbird Coffee is not up here because they're just one entity. They're not publicly traded. So these small caps, thus, are still oftentimes like U.S.-wide companies, still big companies that you've heard of. About 2,000, 2,500 companies here. Just to give you a few you may have heard of. TiVo, GameStop, Abercrombie & Fitch. These are all companies that fit the small cap designation, okay? So why do we care about this? Well, we care about it because when we're investing, we want to diversify. That's the name of the game, diversification. So what if you only invested in the S&P 500? If you only invested in the S&P 500, you'd be getting almost all large caps, right? You'd be getting big companies, and you'd be ignoring these small cap companies down here. That's probably not a very good decision because we want to basically diversify as much as we possibly can. Remember, we want to avoid bad risk. There's a type of risk called idiosyncratic risk. It's sort of unnecessary risk. It doesn't do you any good. We want to avoid that. We only want what's called systematic risk. Systematic risk is risk that you have to be willing to take if you want to invest, okay? So we definitely don't want to invest in just one company. That'd be really silly, right? The same logic applies here. We don't want to just invest in the large caps or just the small caps. We probably want to diversify, okay? Part of the reason for that is that these companies don't always perform the same. If we look at historical returns, this is specifically looking from 1990 to 2018, all right? From 1990 to 2018, I found some data for average annual return. This is annualized return over that period. These large cap stocks have returned about 9.7%, mid caps about 11%, and small caps about 11.8%. All right, now that's just up to 2018. Last couple of years, things have kind of actually switched. The large caps have been doing well. Small and mid caps have not been doing that great. But if you look historically, this has been the trend. And if this has been the trend, if small caps tend to outperform large caps, what do you think about risk? Which companies do you think tend to be more risky, the large caps or the small caps? Indeed, the small caps are more risky, which is probably what you would expect. You know, generally speaking, higher returns mean more risk, and that's what you generally see here. These small caps provide more risk, and the large caps have less risk. On a case-by-case basis, this makes sense, right? Investing in Microsoft is probably less risky than investing in, GameStop, right? But furthermore, it's true for an overall composite too. If you invest in 300 small caps, that's riskier than investing in 300 large caps. These companies just tend to be more stable. So you probably want to have a mix of mid, large, and small caps in your portfolio. And we've got to try to figure out how to do that in a reasonably good way. Just want to show this to you guys real quick. This is the full list of the Dow Jones Industrial Average 30 companies. Again, this is the 30 largest publicly traded companies in the United States. You probably recognize most of these names, companies like Chevron, Coca-Cola, Disney, and so forth. All of these companies are not only listed in the Dow Jones Industrial Average, but they're also in the S&P 500 because the S&P 500 includes the top 500 companies, and of course that encompasses the top 30. Remember that sort of the weird thing about the Dow Jones Industrial Average is that it is price weighted, and so these prices that you see here listed, which are really arbitrary, are going to determine how big of a share each of these companies is in the overall index. So you can see the company that's going to have the biggest bearing on the index is Boeing. If Boeing goes up 10% in value, that is way more important than a company like Cisco going up 10 times in value, simply because of the arbitrary market, the arbitrary price per share mechanism that they use. And so that's why people who really understand personal finance really don't pay attention to the Dow so much.